Hi there, welcome to Ongoing Financial Foundations. My name is Thomas DeShooter. Today we are going to talk about ETFs, exchange traded funds. And in this case, I'm going to use the S&P 500 as our main talking point. So what is an exchange traded fund? Well, it is something that mirrors an index or an indice. In this case, the index that we're going to look at is the S&P 500. So if you buy an exchange traded fund that mirrors the S&P 500, it will go up and down the same as the actual index itself, minus any fees that are charged internally inside the ETF by the promoter. So in this case, Standard & Poor's has created the index, the Standard & Poor's 500, which is the top 500 companies traded on the US stock market. And BlackRock, for example, is one of the largest ETF providers in the world. They have an ETF, an exchange traded fund, that mirrors the S&P 500. And inside of that is a fee that BlackRock collects for providing that trading mechanism for you inside your brokerage account. Now, what are some of the advantages of using an ETF? Well, number one, right off the bat, they're very inexpensive. You can passively invest in the market at a very, very low cost. There's no ongoing broker to take any fees from you. There's no large institution that's going to be taking fees from you. It's simply going to be whatever is charged inside the ETF, and however it performs, you're going to mirror it pretty darn close either on the up or the downswing of the day. It's simple, it's passive investment. So there's not a lot of thinking that goes on here. Whenever you have money available, you can buy more of the S&P 500 ETF and just keep building and building and building that position. There's no guesswork here, right? So we're not looking to find out what are the companies. It's the top 500 companies in the US. If a company falls below that top 500, it will be dropped out of the index automatically, and the next one up will be added back in to that index, and then your ETF will mirror it exactly. These are predominantly used by Roboadvisors. So if you're familiar with Roboadvisors out there, this is what they're using. Typically what they'll do is build you a balanced portfolio. So they'll have the opportunity for you to invest in an index that mirrors a fixed income portfolio. They'll have the opportunity to put you inside of a broad market ETF like the S&P 500. They'll also add in things like emerging market ETFs or an energy traded ETF or a gold ETF. Now, when you get more specific and zeroed in on a particular type of strategy with an ETF, those fees are going to go up. So you got to be careful of that. There's things out there, there's literally thousands of ETFs now. So there's things out there that are 2 times bear market or 2 times bull market, and these charge much higher fees, and you can basically erode your investment inside there through fees. So I would stay away from those unless you fully understand what is truly going on in there. And then that's one of the things that I don't like about ETFs. That would be a minus, is that unless you're really knowledgeable about the entire market, you can get tricked into buying something and not fully understand what it is. So stay away from those types of ETF. Stick to a broad market like the S&P 500, the Dow Jones Industrial Average, the Toronto Stock Exchange, the European Index. You can buy the FTSE out of the UK, et cetera, et cetera. Another small risk to an ETF is there's no one at the helm. And so there's no manager making decisions when the market is going down. So you're going to follow the market straight down if there's no manager involved and you're just buying the ETF itself. In the case of the S&P 500, they're typically all weighted to the largest companies. So the top 5 to 10 companies can have a meaningful impact on the day-to-day valuation of the S&P 500. And the bottom 50 or 100 companies might not have much of an impact at all. So you want to know what are their top holdings inside of the ETF. And you can find that through Yahoo Finance, or you can go right to, if you're using the BlackRock, you can go right to theirs and have a look at exactly what that ETF holds. And then lastly, there's no opportunity for an outlier. So although Warren Buffett will profess the brilliance of just buying a very simple ETF and kind of buy and go away, he made all of his money by being very specific, by buying companies that had a competitive advantage, that had like a moat built around them. So for example, Coke, nobody else has the Coke recipe. He made large investments in these type of companies. So he made big bets on them once he had done his research. So if you're not willing to do that kind of legwork in understanding exactly what a company does, this is your next best solution in terms of a real passive, low-cost investment opportunity. Thanks so much for joining me. My name is Thomas DeShooter. This is Financial Foundations Ongoing. Please subscribe down below there. Click the little button, and you'll get notice of our very next video. Thanks again.